Alrighty, let's go ahead and get started. If anyone has any questions, please again make sure that you type those into the chat box, as all audio on your end has been muted. So just keep that in mind. Alrighty. Okay, a little bit about myself. My name is Alex Perny with Advanta IRA. I've been doing this since about 2012. I cut my teeth doing investments for clients for the first 4 or 5 years of my career, and then moved over into business development and education. So I have a lot of experience in seeing a lot of different ways that some of these kind of investments play out, how these things can be applied, what type of issues people run into. So again, if you do have any questions, make sure that you do type them into the chat box. I am happy to address them as best I can, but just keep in mind there might be limitations as to what I can and can't answer specifically. With that said, I just need to read a quick disclaimer, especially since we're going to be covering some rather high-level tax issues, is that Advanta IRA and our employees do not provide investment advice or endorse any products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of financial investment. A little bit about Advanta IRA. We're about to click over into our 20th year in business. We strictly handle self-directed and alternative assets within qualified retirement plans, such as IRAs, 401ks, and the like. So again, we have plenty of experience in doing this, as it is all that we do. Currently, we administer a little bit over $2 billion worth of assets under administration, with about 8,000 individual clients and 13,000 individual accounts. So again, goes to show that we've definitely seen a lot of this kind of thing go on, and we do offer dedicated account management for any client that is a client of ours. So important things to understand kind of on face value are what types of plans might be subject to UBIT and UDFI. And we'll get into the differences between the two, because they're more often than not kind of lumped together when people think that they have a UBIT liability or an unrelated business income tax liability. More often than not, it is actually a UDFI liability. And UDFI is primarily what most people are concerned with when it comes to actually investing with their self-directed retirement plans, because there's debt involved in some type of real estate project, whether that be a commercial real estate syndication or other type of investment structure. So just keep in mind that there are differences between the two. But even though a lot of people think, hey, if I have a solo 401k, it exempts me from UBIT, that's not the case. UBIT specifically is a broader ranging type of tax that we'll get into in a minute, but it can apply to solo 401ks. The exemption for solo 401ks and qualified retirement plans is very narrow in its scope, although very, very powerful. But just keep in mind that if you have any of these types of plans, you might have one of these liabilities depending on what type of investment structure that you are pursuing with that plan. So again, if you're just kind of listening in, plans that can be subject to UBIT and UDFI are your traditional IRA, your Roth IRAs, simple IRAs, solo 401ks, SEP IRAs, any type of old former retirement plan from an employer, health savings accounts, education savings accounts. Really any type of account that we administer can potentially have one of these liabilities. And although, again, that a lot of people go on the assumption that 401ks and qualified retirement plans, such as your solo 401k or smaller business plans can just be exempted from it, that's not the case in 100% of the time. So what is UBIT? So UBIT and UDFI are two completely separate different types of taxes. Now, they're kind of codified in the Internal Revenue Code under the same bucket, but they are very separate. So it's important to understand what the difference between these two things is in order to better understand how you can identify, avoid, mitigate, and generally just kind of understand where these things might play out. So what is UBIT? UBIT is a tax levied to an IRA or retirement plan when it receives income from a trade or business rather than passive investment income. So that means that, let's say you have an IRA and you want to buy a laundromat, or you want to buy a car wash, or you want to buy something that sells trinkets on the street on Bourbon Street. Something that is an active trade or business that's not considered passive. Sorry, Yosef, I unfortunately I can't really do anything about the audio. It really is what it is. So what is UBIT? So again, that is what the tax is levied when it receives income from a trade or business. So important to understand, if it's, again, some type of active trade or business, then that is what you're going to be up against when it comes to understanding where this might come in. And UBIT, there is no necessary exemption from just the type of account that you have. So if you have an account, let's say a 401k that wants to own, half of the membership units of an LLC that runs a laundromat, then you might very well have a UBIT liability, even though 401ks and qualified retirement plans are exempted from UDFI in some instances. It doesn't give a kind of across the board exemption from all these kind of taxes, which is important to understand. So what is business income? Common areas where IRA investors encounter business income is LLC membership, taxes that pass through. If an entity sells goods or services. So again, you're investing in this like LLC membership or direct equitable ownership of something, taxes that pass through, or an LLC, then UBIT is certainly going to potentially apply to your IRA investment. However, the primary way that most people aim to block this is by investing into shares of a C Corp. Now, on the smaller end of the spectrum, it's kind of hard to justify that in some instances because then you're electing to have that business tax and corporate tax rates. Well, if your IRA is a minority investor or it's a larger pooled investment, then C Corp structure could certainly be beneficial for some of those types of structures. But if you want to invest in your IRA, let's say there's several of you that have IRAs or 401ks that want to own an operational business, the benefit of having the tax qualified plans own it would be that, hey, no taxes are paid on the revenues coming in. Well, if it's an active trader business, there definitely would be. So to elect to have it taxed at corporate tax rates, well, it's which pill is easier to swallow in that instance. And again, that's going to come down to kind of personal preference and what makes the most sense for the investment. But a general rule is that if you are trying to shield retirement plans from the UBIT tax of an active trader business or unrelated debt finance income tax, or the UDFI portion of this, what we're going to cover today, utilizing ownership of a C Corp can be very beneficial. But again, the C Corp can typically block some of those pass-throughs like depreciation, amortization, write-offs from coming back into the end-use investor, because the end-use investor is going to be typically getting paid out on something like a dividend or a shareholder disbursement, and the ability to pass through tax write-offs is much more narrow than investing in something like an LLC or a limited partnership, where you are able to pass through those types of tax write-offs for the income that is realized by the owners. So again, UBIT being separate from UDFI is important to understand. UBIT being related to business income and UDFI being related to debt. We'll get into more of that in a second. And what is considered investment income? Income that is generated from rental of real estate, note interest, dividends, royalties, capital gains. Those are exempted from UBIT. So active trader business, so the business, the LLC, is selling trinkets. It has a car wash, rank and file employees, regular business income. But investment income being exempted from UBIT, things like dividends, royalties, capital gains, those are going to be exempted. So there are some carve-outs where you may have a UBIT liability for some of the income and may not have it for others. So it's important to understand that just because that you maybe invest in an active trader business, not all of the derivative income might be subject to UBIT, but it's definitely important to check with a tax or legal counsel to make sure that if you do have to file what's called a 990T, and we'll get into that in a moment, that you are qualifying just the income that would be subjected to this tax and not the entirety of the amount of revenues that are coming back to the retirement plan. And keep in mind, sorry, the slides are advancing a little slowly, but if you have any questions, make sure you type those in. Sorry, it's just taking a second to advance this slide. Okay, what is UDFI? This is what most often people are going to encounter when investing through a self-directed IRA, or are going to hopefully be exempt from by utilizing a solo 401k. So what is UDFI? Unrelated debt finance income tax is a tax applied to profits or gains attributable to debt that an IRA has invested in. So typically when you look at debt in relation to retirement plans, you're looking at stuff like, commercial real estate syndications, where the limited partners have basically funded the down payment for the syndication to go out and borrow the remaining capital to purchase the asset, the piece of real estate, or individuals that want to invest in single family homes with an IRA, which is very, very popular. We probably administer almost $1 billion of real estate assets for our clients. But real estate is many things, and one of the things that it is not is cheap. So a lot of times people that can't buy cash or can't form a partnership might need to finance the purchase with the IRA. So that would definitely bring up a UDFI liability. Now, what exactly does this have to do with it? An IRA or 401k can use non-recourse debt to finance the purchase of an asset, but when debt is used, the IRA returns attributable to the finance portion are taxable. Now, this definitely gets a little bit into the realm of complexity because you have to look at it very analytically to kind of understand it. So I'll give as easy of an example as I can for an IRA investing into something that would have a UDFI liability. And we'll get into a better case study, but imagine first, if you will, that you have a $200,000 property that the IRA has put down $100,000 on, finances the other $100,000, and then it nets, let's say, $2,000 a month in rent. So at the end of the year, you have $24,000 of attributable rents to that property. Let's just say this property is purchased in Narnia, and there's no taxes, there's no depreciation, anything else like that. So at the end of the year, you have $12,000 that would be subjected to a UDFI liability filing, and $12,000 that would be not. Now, the amortization on the loan also affects the underlying amount that you have to pay. So that ratio goes down the more you pay off, and once eventually the property is paid off, there's no more UDFI liability because the property is owned free and clear. So IRAs definitely have a much harder time when it comes to dealing with UDFI because either they invest into an entity that is filing as a C Corp, or they have to have, a lot of depreciation and write-offs on the property to help try to offset the cost of that particular deal. So again, important to understand that IRAs definitely run into a lot more issues when it comes to UDFI than, let's say, something like a 401k. In the specific scenario with a 401k of buying real estate with non-recourse financing, a 401k would not be subjected to UDFI, which is awesome. If the debt in the plan was used for non-real estate assets, however, the tax would apply. Additionally, IRAs would typically always be subjected to UDFI. So again, UDFI, the exemption for 401k plans, is very narrow, but it can also be, looked at as very broad as well, because if you are investing in any type of real estate debt structure, then 401ks are typically going to be exempt from it. However, let's say I had a client bring this up to me and said, hey, I would like to invest into this LLC that's going to be taking on debt with my 401k. I should be exempted from UDFI. I'm like, yeah, absolutely. If it's buying real estate, certainly. But he said no. Actually, what they were looking to do was going in and buying surplus inventory, getting debt to buy surplus inventory from different businesses, mainly in the construction trade. So projects that ordered too much plywood or decking, 2x4s, that kind of thing, and taking it and then reselling it for a profit. Unfortunately, that would be subjected to UDFI because it was not real estate that was being purchased with the underlying debt. So again, there's definitely some more unique use cases where you might not necessarily be, privy to that exemption. Got a great question. What is non-recourse debt? And of course, when I do these kind of presentations, I maybe wrongly assume that people are familiar with all these terms, but I'm certainly happy to alleviate some of those concerns. So, what is non-recourse debt? So let's define what recourse debt is first. So if you bought a home or you borrowed money in the past, let's just use again a single family home mortgage. When you go to sign all the documents, you sign a loan saying, hey, I'm borrowing $100,000 to buy this $200,000 home, right? Well, let's say that you get in the arrears and you can't pay, and then the $100,000 that you owe the bank is, let's say the property is now worth $80,000. It really took a dive. So the bank is short $20,000 of value when they foreclose. Well, when you sign a personal guarantee to that loan, that means that they have recourse against you personally to come after that other $20,000. That is the recourse on the loan, is that they can come after the property and you personally. You've given a personal guarantee. With non-recourse debt, what it means is that in the event of default, the lender can only take the property. They cannot be satisfied by any type of personal guarantee of creditworthiness or other assets, or any type of additional capital that you might have to make them whole. So in the event of default, the only thing that the lender can come after is just the property. Now, these types of loans are very common in large commercial multifamily real estate. Not as common in the single family space, but there are certainly lenders out there that do it. So just keep that in mind if it's a something you're looking to utilize for single family homes. A little bit harder to find the commercial lenders that'll do it, but not to say you can't find a non-disqualified individual to underwrite that loan for you. You can certainly get non-recourse debt from almost anywhere. It just has to be correctly titled. That's again maybe the most broad definition I can give without getting too far in the weeds. And this is a good place to kind of answer a few questions. Let's see. Does a limited partnership instead of an LLC or C Corp also avoid UBIT for an IRA? No, it wouldn't, because a limited partnership is typically always going to be taxed as a pass-through, which is inherently one of the big benefits to investing in a limited partnership, is all of the large amounts of depreciation and write-offs that get passed through to the limited partners. I don't know if you could file a limited partnership and have it taxed as a C Corp. I don't know if you could or necessarily would want to, but limited partnerships don't typically offer shielding from UDFI liabilities. Now, that's not to say that the amount of write-offs that you can capture from it don't help to offset that, and we'll get into that in a minute. Just because IRAs typically don't get to take, if an IRA buys a property cash, it can't take advantage of write-offs and everything if it bought it cash, such as depreciation and expenses and things like that. But if there is debt, it has to file a tax return on 990T. It gets to take advantage of all those write-offs and some other automatic deductions that the IRS gives. We'll get into those in a minute. So just keep in mind that just because an IRA might be subject to a UDFI or a UBIT liability does not necessarily mean that it's going to be extremely cumbersome or expensive. I mean, it certainly can be, but you do have a lot of tools that are offered to you when investing with debt structures, or you're investing in something that might have UBIT that would allow you to kind of mitigate that to a pretty good degree. And last one before we keep moving on, if I use my solo 401k for the down payment and rehab on a rental home, is that a non-recourse loan? Well, it would have to be a non-recourse loan for that, to that question that was posed. So if your 401k wants to borrow money, it has to be a non-recourse loan. And again, a 401k borrowing money doesn't automatically make it non-recourse. You have to make sure it is non-recourse. So essentially making sure that the note clearly indicates that there's no personal guarantee being levied by you as the trustee of the plan. You're not pledging any other personal assets as collateral, and that the lender agrees in the event of default to only come after that property. Is their only recourse in the event of default is just the property, not anything else. So again, hope that answers the questions. Keep them rolling in. Let's keep moving on here for a minute, so that way we don't get too far in the weeds. But again, great questions. Keep them coming in, and when we get to another good stopping point, we will certainly jump into answer some more of those. So if an IRA or a 401k has to file for a UBIT or UDFI liability, it is not done on your own personal tax return. IRAs and 401ks operate most analogous to trusts. They are certainly owned by you in a sense. You get all the benefit from them. But just like a trust separates the ownership and title from you personally in a legal sense, same thing kind of happens with an IRA. So it would have to file its own separate tax return. And the tax return for these liabilities is what's called 990-T, or more commonly abbreviated as 990T. So this is what you'd have to file. Now, keep in mind that if your 401k or IRA has to file this, it does need a tax ID number. I would encourage you to reach out to your custodian. Hopefully that custodian is Advanta, and let us help you apply for that tax ID number, because I have seen humongous issues with clients that have filed using either our trust tax ID number, their personal social on the tax return. So it is very important to at least take that first step. Second step I would encourage you is to definitely contact a CPA or tax advisor that's familiar with filing these. The broader sense of the people that typically file these are nonprofits. So if you find a CPA that's familiar with nonprofit tax return filings, that's a good place to start. You can always ask your CPA or attorney if they have someone familiar with this. But those are the types of business entities that typically have to file this tax return, because it's also used for, it's basically a tax return for revenues generated outside of a tax exempt vehicle. So nonprofits, charities, things like that have to file 990T. So that's a good place to start. But getting back on course, if a UBIT or UDFI liability is owed by a retirement plan, then 990T needs to be filed. 990T's filing date is the timely date of the given year, typically April 15th. UBIT taxes only need to be reported and paid if the total owed is over $1,000. Now, keep in mind, so basically the IRS says you get $1,000 automatic deduction on any amount of UBIT liability basis, or UBIT liability calculation. So whatever the total amount of revenues that would be subjected to UBIT, if it's under $1,000, you don't need to file a report. And the nice thing is that you do get to take advantage of things like depreciation, amortization, write-offs, all that kind of good stuff. Cost seg, if you're in a large commercial multifamily deal, all that kind of good stuff gets to be passed through to your IRA as the investor. So keep in mind that this is a very powerful tool, because just because a particular investment vehicle might have a liability you need to be concerned with, and you certainly should be concerned with it, doesn't necessarily mean that you don't have enough tools, and like most real estate investors would typically be doing, to offset any, almost all, if not most, of the income. And also keep in mind that if you do have one of these liabilities, any revenues that are then in turn going back into the qualified retirement plan, the IRA, the 401k, are then going to be, completely tax exempt from future, income when you're investing it. Now, the specifics of that statement need to be predicated on, whether it's a Roth or traditional. So again, there's some nuance to that kind of statement, but just keep in mind that you are being able to plug all of the stuff back in to a retirement plan. So the tax benefit and the nature of that is going to be pretty pronounced. So let's look at some of the pros and cons of using an IRA versus a 401k when it comes to investing in general, because not everyone can necessarily qualify for one versus the other, and maybe the overhead, the cost, the burden of doing one versus the other, might help make a decision. Just because you might have to file a tax return doesn't necessarily mean that you should necessarily shy away from one versus the other. We had a question pop up. I think it'd be good. It's pretty quick. Someone asked, I thought you didn't get to take advantage of depreciation through a Roth IRA since it's already a tax advantaged account. Well, all of these are tax advantaged. Roth, SEP, traditional 401k, all of them are, quote, tax advantaged. Roth just happens to be an after-tax account, meaning that you front-loaded the tax payment on everything going in and you pay no taxes going out if it's a qualified distribution of any earnings attributable to your contributions or conversions. Now, when you do have a liability that tax liability that might need to be paid from an IRA, that might be, it's not just pre-tax accounts that have to worry about this. Again, it is any type of retirement plan. So Roth 401ks, Roth IRAs, even if it is after tax, some of these liabilities can still certainly apply. But the benefit is that because now you have to file a tax return for the account, then you get to take advantage of depreciation and write-offs, because you get to file that return and help to chip away at the ultimate liability when you go to file. So great question, but I just want to be specific on why exactly that is the case. So why might someone want to use an IRA versus solo 401k? Let's start with an IRA. They're easier to establish. Everyone can qualify if they have existing retirement funds. If you want one, you can have one with an IRA. They're great. The IRA custodian does all the annual reporting that you need to do on these types of plans. There's no need to validate an IRA like a 401k. You can use a blocker corporation to limit UBIT, but you do have to, again, be creative with how you are structuring things, because you would need to kind of loop in and using C Corps, which, essentially would have to pay corporate tax rates. But if you are creative or savvy with taxes, you might be able to eliminate the corporate tax rate with what you're doing anyway. So maybe using a blocker corporation and an IRA might be very advantageous. You can use deductions and depreciation to offset income. No UBIT for the first few years is definitely a possibility, and we'll get into that in the case studies we're going to go over here in a minute. So some cons. They can be subject to UDFI, unleveraged income. That's no real way around it. If you're not using some type of blocker corporation, UDFI can certainly apply, and it's something you definitely need to be aware of. You can use depreciation and deductions to offset that. Profits at the end of the deal can potentially be subjected to a 37% tax without blocker corporations and other things going into it. So UDFI and UBIT taxes can get fairly garrulous fairly quickly because they are taxed at trust rates. So you need to keep that in mind, that these taxes can be cumbersome, to say the least. But there are a lot of tools to help you offset that, and we're going to go through some of those in a minute. And you also have the additional costs of preparing a 990T if you have unrelated debt finance income tax liabilities at the end of a debt leveraged real estate deal. That's a mouthful. I've ever said one. But you also have that additional expense of potentially needing to file that, finding someone that's competent to do it and calculate it, and making sure you're doing it in good faith. It's something to consider. So what are some pros and cons of using a solo 401k? They're not subjected to UDFI on income related to leveraged real estate, which is huge because let's be honest, most of the time when clients come to us, and I would assume most of the people on this call, is that if you are going to be getting into the realm of using debt for the UDFI side of this thing, you are probably looking at real estate. The creative person I had that came, the individual that I had that came to me and said, hey, I want to use my 401k in a leveraged deal to buy, surplus construction materials. That's definitely an outlier. That's definitely the minority of things that we see. Definitely more common are things of real estate or real estate adjacent. So the ability to utilize that exemption for debt leveraged real estate for solo 401ks is very pronounced. And it's the nice thing about being able to take advantage of that exemption. You don't have to do anything. More often than not, when it comes to the IRS, there's something you have to do, some weird form you have to file, a notification that makes you say, hey, look, I'm exempt from this. You don't have to do anything. The solo 401k is invested into a debt leveraged real estate deal, whether that be a limited partnership, shares of an LLC, owns the property directly. It is just an automatic exemption from having to pay UDFI. You don't even need to file 990T. Another benefit of solo 401ks, you can adopt checkbook control simply by leasing the plan documents. So 401ks give you a little bit more degree of flexibility when it comes to how you administer them. You can accept rollovers from IRAs and old 401k plans to help fund them. You just can't accept a Roth IRA into a Roth 401k. It's a really weird rule. I'm not sure why the IRS did that. It's their rule. You can have a Roth 401k. You just can't roll over a Roth IRA into a Roth 401k. Strange, I know, but that's what it is. And you have significantly larger annual contribution limits and the ability to take personal loans than in a solo 401k than an IRA. So to give you an idea of how much more money you can just contribute out of your own pocket on an annual basis, and there's a bit of an asterisk to that between solo 401ks and IRAs. Currently, right now, for an IRA, you can contribute $6,500 or $7,500, depending on your age. Okay, it's not a ton of money, but again, it's something. You're not going to walk by a stack of $7,000 on the street and not pick it up, but it's certainly, when you're talking about buying real estate, it doesn't get you very close very quickly to buying real estate, especially in today's market. Solo 401ks, and again, I won't get too far into the weeds. I've taught whole classes on specifically like choosing these plans, how to contribute, how to calculate. But just keep in mind, on a maximum basis, let's say you earned $100,000 from the 401k from the business the 401k is attached to. You can contribute almost $50,000, depending on your age, into that plan per year as a tax write-off. Pretty cool stuff. Again, I won't get too far into it, but the disparity between how much money you can potentially plug into a 401k versus an IRA in a given year is large. Some of the cons about solo 401ks: you have to have a valid sponsoring business. Unlike IRAs, where essentially if you think, therefore you are, and you would like one, you can have one. 401ks are inherently always going to be married to a business. They are attached. A 401k is not applied for, it is adopted. Essentially, a business has to adopt that plan. Now, when I say business, it doesn't have to be something as formalized as a large LLC with a bunch of employees, working around and being productive. A sole proprietor can have a solo 401k, an individually owned single member LLC, a contractor, so any type of self-employed income, you can qualify for a solo 401k. But, and I've had this conversation with many people, is that if you want one, that's awesome. But if you are 9 to 5 W-2 employee that clocks in, clocks out. You don't have any type of, let's say an LLC that might own some rental property, or you do some consulting. If the only revenue source you have is from your W-2 employer, you can't just open up a solo 401k and have one. Unfortunately, it was reserved for some type of sponsoring a qualified business. You just have to. There's no way around it, but just keep in mind that that is the case. You need to make some annual valid contributions. There's some arguments to be made that says, oh, well, I have this LLC, I'm just going to attach it to this LLC. Well, anyone can create an LLC. If you have a couple $100 and an internet connection, you can go onto your Department of Corporations in your state and you can create an LLC. It takes about 25 minutes. You go through everything, apply for the tax ID number, and boom, you have an LLC. But that really doesn't, in good faith, kind of qualify you for having a solo 401k. There needs to be some either ability or attempt every year to contribute to that solo 401k. So if you just have an LLC in name only, well, yes, on paper, okay, you can attach a 401k to it. Really, you didn't do that for any other reason than creating the 401k. And I would almost guarantee if that ever went before the IRS, they would definitely have some issues with that. So while you're not required to make an annual contribution to a 401k, let's say you just didn't want to contribute that year, you're not obligated to, but you would either need to have done some or have the ability to have done some on an annual basis in order to kind of make it, a 401k in good standing, if you will. 401ks also have some additional costs in preparing what's called 5500 EZ, which is basically kind of, think about it like the annual report for the 401k. It's basically kind of like an annual report for an LLC in a particular state that it operates in. It's not a tax return. It's basically just letting the Department of Labor and the IRS know, say, hey, we have X number of employees. Here's the total plan value. Here's the trustee. You might have to do that. The reason I say might is that plans that aren't utilizing a ROBS, a rollover for business startup structure, which just take that for what it is. If you want more information, email me. Or that have plan assets totaling less than $250,000 don't have to file a 5500 EZ. And as a trustee of the plan, you are responsible for all that plan reporting. Advanta does not do that. However, we have started offering the ability to do that, but there is a premium that you would have to pay on the price, but it is still very cheap in the grand scheme of things. But just understand there's definitely a lot more that goes into solo 401ks. Yes, some of the flexibility and tax exemptions that they offer are pretty awesome, but it's not as simple as just doing an IRA. So someone says, in fact, it's another con of the solo 401k that you can't have employees. Well, yes and no. That a solo 401k is basically just the accumulation of exemptions for owner-operated or spousally operated businesses. So that means that some of the plan reporting and additional compliance and discrimination testing does not have to be done for a solo 401k. In reality, solo 401k is more of a marketing term. If you look up the IRS tax code, you're just going to see 401ks and retirement plans, and they're qualified under individual business owners or sole operator plans. You get a lot of exemptions for doing that. Now, these types of other things with 401ks, as far as exempting from UDFI, those exemptions apply all the way up the chain, if you will. If you have a business that has rank and file employees, or someone outside the equitable ownership of the business. But just to say that a solo 401k has to be one person also isn't true. It can cover a owner-operated business. So if you have a couple partners and everyone's an equitable owner, it can cover you and your spouse, and things like that. So just keep in mind, a solo 401k doesn't always mean one, but for more or less, it definitely does. So with that said, a solo 401ks typically get, they get, I wouldn't say exponentially more expensive, but a pretty good degree more expensive once you start bringing in rank and file employees. And the last thing I'll say on that, what is an employee? It's someone that works over 500 hours per year over a 3-year testing period, or over 1,000 hours per year in any single given year is considered a eligible employee for participation in an employer-sponsored retirement plan under what's called ERISA, ERISA. Won't go too far into the weeds on that, but good point. And then lastly, before we move on to the next slide, which are getting into case studies, did you say You don't need to file the EC if your balance is under 250K. Yes, but more specifically, plan value under 250K. So if you just have a checking account with $249,999.99 at the end of the year, don't need to file. You bump that up by 2 cents, you do. But it's based on plan asset value. So, if 1 year, let's say you had plan assets worth a total of 400,000, great. Let's say you rolled some money out of it and then you have a lot of depreciation in the asset values, then potentially might have to file the next year. So just keep it in mind that $250,000 is an exemption from filing $5,500 for the plan. Okay, last one, and then we will move on, I promise. If I have a W-2 job but do day trading on the side, could I create a business for the day trading that would allow me to create a solo 401k? First, I'm going to preface that with saying check with a tax advisor to see if what it would mean to create a business around day trading. But in a very high level answer is that if you have some type of business that you own or operate individually, it doesn't matter if that is selling, water to an Olympic swimmer, or if it's selling, whatever it is, or if you're doing day trading, or any type of unique or different type of business activity. Yes, you could have a solo 401k for that. So if you wanted to turn your day trading into a business, certainly. I've seen people get real creative with creating, and again, real businesses. You can't just say, hey, I'm going to create a business for thinking about selling Beanie Babies on eBay. You would actually need to start selling those Beanie Babies for it to be a real business. But it sounds like for you, you definitely have some type of activity that could be rolled into a business that could help you qualify for a solo 401k. All right, moving on. If my thing will let me advance the slide. Case studies. Here's where we're going to get really into the meat of it. Okay, I'm actually going to show you and break it down for you what a UDFI liability looks like for an IRA, and then also the really awesome fact about how a 401k would completely exempt someone from this. Alrighty. Okay, I think these slides are a little bit, they're back and forth. So let's start here and we'll go back. So, investing in syndications and private placements. This is Jane and Rocky's deal. Jane has over $100 grand in an IRA with Vanguard. She meets Rocky as a private offering to purchase and remodel an apartment complex. Sounds great. So he's raising capital. Let's just call this a real estate syndication. Rocky provides Jane with a subscription documents prospectus. The project's going to be 70-30 leverage. So they're raising 30% for the down payment, and they're going to finance the other 70. So what does she need to do in this case? She needs to open her Advanta IRA account, completes her transfer paperwork, gets the money over from Vanguard, and then we're kind of basically in a good position to get things started. So the investment process. We work with the account manager to get our investment provider the completed documents, subscribe in the correct name of the IRA to the limited partnership subscription agreement. Tax ID number is the trust tax ID for Advanta, not her personal social. We sign all the sub docs, and then we go from there. So quarterly distributions in this are going to be $2,000, $8,000 a year sent back to the IRA. We receive the deposits, put it into the account. The gains are not included in her personal income, but she's going to be subject to UBIT, or unrelated debt finance income tax, should change that, on a portion of the $8,000. She'll hire a CPA to prepare 990T, and any taxes paid by the IRA. Also important to remember, the IRA is liable for paying this debt, not you personally, which could be a good or a bad thing. My opinion, the more money you can keep within a tax qualified plan, the better. But if you're investing, inside an IRA, getting an additional bill for having to pay taxes for the IRA, also not exactly the best thing in the world either. So here's what it kind of looks like. And I have a good slide next. It's really going to kind of break this down. If a project is 70% leveraged, then 70% of the income quarterly distributions payoff returned to the IRA is going to be subject to UBIT taxes, or specifically UDFI. The IRA receives a K-1 from the syndication showing all income and allocations. And allocations in this specific instance refer to depreciation, amortization, cost seg analysis, accelerated depreciation, recapture, all that kind of good stuff can get allocated to IRAs. Specifically, if you are investing with a commercial real estate syndication fund, make sure that they do allocate those depreciation and write-offs to IRAs. I have seen some people get into pretty bad positions by, that not being allocated to the IRA investors. So make sure they allocate that for the IRA investors, and specifically if you're using an IRA. Again, it's kind of a moot point if you're going to be investing with a 401k. So, again, keep that in mind. If they elect to put this into a C Corp, or if your IRA invests into 100% of the ownership of a C Corp and then funds it, and then that C Corp in turn subscribes the limited partnership, then you might be able to block the UBIT or UDFI tax completely. So, we'd be paying 21% C Corp taxes versus 37% potential UBIT or UDFI tax. It's definitely something to consider. That definitely gets more into the realm of needing to talk to, a tax advisor or a tax attorney to make sure you really get good information there. But keep in mind that even with an IRA, there are some potential ways to block it, but it's definitely not as straightforward or not as easy as simply being able to utilize a solo 401k. So to the question that someone said, hey, if I day trade, could I, form a business around that to have a solo 401k? That might be a little bit easier than trying to go through the route of forming a C Corp for your IRA to own, for then in turn that entity to invest in the limited partnership real estate syndication. So, trying to pick the path of least resistance that offers you the most benefit, is something that would definitely be encouraged. But make sure you get good advice on this stuff because, kind of in the wind, or I shouldn't say, it's kind of, heady as this topic can be. It's definitely good to get good advice. Just keep in mind, I can't give you that advice. IRA files, so how do you pay this stuff? So the IRA files IRS Form 990T and can deduct a percentage of expenses and cost segregation and depreciation. Plus, you get an automatic $1,000 write-off and deductions from the IRS. It's paid at trust tax rates with top out in the mid 37% in the taxes paid by the IRA. Losses can be carried forward if 990T is filed. So you do have the ability to carry forward losses that might be attributable to the actual investment structure if they're not all captured or utilized in a given year, or if you don't want to claim them, you can carry them forward. So strategy may be saying, hey, if we don't have a whole lot of income, I want to carry forward these losses to when it sells and I might have a significant gain. Could be a tax strategy you can utilize. Again, you have to check with a tax advisor or attorney to make sure you're doing that correctly and in good faith. Can't stress that enough. I can kind of only give you the high level stuff and just, make sure that you understand the questions you would need to ask if you really want to make sure you're doing this correctly. So here's what people probably really want to see. How does this actually play out? What does it look like from this $100,000 investment going into a commercial real estate syndication when it's an IRA? All right, what's it look like? So we have an annual 8% return on the $100,000, right? So we have $8,000 that is coming into the IRA. The amount of income subject to UBIT or unrelated business income tax or unrelated debt finance income tax more specifically is going to be 70% year one, 60% year two, 50% year three because of the payoff of the loan. Because the less that is owed on the loan, the ratio of UDFI liability goes down. Because essentially, if you held this out so they repaid the entire loan, then there would be no liability to the investors because the property would be owned free and clear. So keep that in mind. But back to this example, you have that $8,000, and then through the K1 and the asset and the depreciation allocations, your IRA gets an additional 56. Let me go back. I'm getting ahead of myself. So that $8,000, the amount subject to UBIT is going to be $5,600 because it has to do with the underlying basis to debt ratio. Then you have an automatic $1,000 deduction per year. Deduction, cost seg, accelerated depreciation applied as an additional $5,600. So that first year, the IRA doesn't even have to file 990T. It gets the whole thing. It gets the whole $8,000 deposited into the account. Year two, again, 8% return on the $100,000. The amount of income subject to UDFI is going to be $4,800 because there's been principal reduction in that loan. You get an automatic $1,000 write-off that second year from the IRS. Now, because the allocations for depreciation, deductions, cost seg, and accelerated depreciation was mainly captured in year one, you only get a $1,000 deduction for that to write off the income for the second year. So the total taxable income For the second year is $2,800 at 24% UDFI trust rates. That's $672 that needs to be paid in taxes for the IRA. So you get to capture $7,328. Still pretty good, right? So year three, this is when the exit happens. You have $8,000, which is your 8% annualized return, plus $20,000 is what you get over and above your principal that you invested that year. So this year you're getting 28 grand coming back to the IRA. The amount of income subject to UDFI this year is going to be $14,000 because remember, it's a ratio of how much debt is owed over the course of the year is to determine how much of that is actually how much of that 28,000 is actually calculable for the debt line for the liability. So $14,000 is what you have for the amount that you have to calculate as potentially taxable. You get to write $1,000 of that off from the IRS. The remaining deductions, cost seg, and accelerated depreciation, $1,000. So you have $12,000, which would be subject to UDFI. So you have to pay $4,200 or a 35% tax rate on that amount of money that came in to the IRA that year. So what does this look like in total? In 3 years, you have realized $44,000 of total income to the IRA on the $100,000 investment. You have $24,400 of UBIT liability income that had to be calculated. You got $3,000 of automatic write-offs from the IRS. The depreciation, write-offs, and everything else that were allocated to your IRA as a K1 investor, as a limited partner investor through K1 pass-through, is $7,600, meaning that the taxable income total was $14,800 for a total payment to the IRS over that 3 years of $4,800 and change, meaning that at the end of 3 years, your $100,000 investment brought in $39,128 of total revenues. So do the math real quick. That's still a very good rate of return over 3 years, even though you had to pay the IRS some money. And the great thing is that that $39,000 is now in a tax sheltered account. So you could potentially invest that would have zero UDFI or UBIT liability. You could even get more creative or continue to do this until you can start buying stuff cash on your own. Or again, this isn't as bad as people make it seem. Now, to make this even easier, if a solo 401k had done this investment, that total at the end of 3 years would have been the full amount of $44,000 made. So yeah, if you can use a solo 401k and not have to kick out the VIG to the IRS, 100%, yeah, absolutely, definitely a good way to go. You do have to consider the additional complexities, some additional costs, and overhead for maintaining a solo 401k plan. But if you can take in $44,000 instead of $39,000, why not? So again, that's what it kind of looks like in a broken down format for someone investing $100,000 into a limited partnership, debt finance real estate syndication. Again, it does tend to get a little in the weeds and a little heavy with regards to doing these calculations and understanding where all this stuff comes from. But I hope everyone got kind of a good, rounded understanding of what these taxes are, where they might apply, what might exempt you from them. And if you are subject to them, it's not the end of the world. The whole amount is not going to be a liability. There's ways to either try to shield yourself by using something like a C Corp, or potentially maybe making it out to be, still a very good rate of return, even though you had to pay some money to the IRS. So with that said, I'm here to answer any questions. We got about 10 minutes left in our time slot today, so we got you out there pretty good on time. So again, I want to thank everyone for joining us today. I really do enjoy this kind of stuff when it comes to retirement plans. I enjoy the complex and the more fringe things. So I hope it came through. I hope you got some good information. I want to be a resource. Please let me know how I can help you. My contact information is right there. If you would like a copy of the slides, they are attached as a handout. But I'll stick around for another few minutes while we still have people logged on to answer any questions that you might have. Again, thanks for joining us today. Can the presentation be shared? Absolutely. You'll get a copy of the recorded YouTube link in about 24 hours if you registered for it. You can share that, rewatch it. Also, if you want, the slides are attached as a handout. When do long-term capital gain trust tax rates apply? Well, they really don't. In maybe certain circumstances with an investment. Maybe if you're using a C corp, they might. But typically, when you do the UDFI filing, all the funds that are going to be then in turn replaced the back into the plan are going to be just considered, basis of that tax qualified plan. So you reinvesting the profits from something that had a UDFI liability, there really isn't a need or an ability to. There really isn't a worry for long-term capital gains in that sense. Okay, why is the LP making 100? Ooh, good questions. Let's see, I scroll a bit. Why is the LP making the $100,000 cash investment, i.e., no debt, subject to this tax just because the GPs use debt? Well, it just that's basically the structure of it. Typically, in commercial syndicated multifamily investments, you have the passive investors, which are your limited partners, which basically just plug in as a passive position to help raise the capital. The general partners are going to be an active role in the business of active managerial duties with it. So that's it. But the limited partnership in whole is what takes on the debt. So I hope that answers the question. I'm not sure. So someone asked, I thought the rate used was capital tax rate rather than trust rates. Is there a circumstance where capital gains rates is used for UBIT or UDFI? Not that I know of. In my 11 years, it's always been basically pegged on trust rates. So, and let's see. I want to be extra sure. If I invest in a syndicated real estate deal that offers both interest and capital gains, subject to UBIT or UDFI, it's tough for me to kind of answer on just that little bit of limited information. Joyce, if you want to give me a call, you can certainly call or shoot me an email. We can schedule something to kind of go through that a little bit more deeply. I definitely need some more information on that. The LP doesn't take on the debt, I thought. Well, no, not necessarily. The limited partner is investing into the syndication as a whole, and the syndication is taking on the debt. So the pass-through of any type of tax benefits are going to be realized by the limited partners. So it's not just the general partners, they're the ones signing the note, but the syndication as a whole is what's taking on the debt. And because your investment is based in a debt leveraged real estate deal, then UDFI would typically apply. Well, the GPs take on the debt and take on the risk of taking on the debt. Yes, if they have to offer a guarantee, they're the ones on the hook for any legal implications of that. But the limited partnership in general would still pass through a UDFI liability because the basis of the investment's a debt real estate is a debt leveraged piece of real estate. Great question. Always fun to answer the more complicated stuff that I don't get to deal with on a day-to-day basis. But again, keep them coming in. We got another 5 minutes before I shut it down. So if anyone has any burning questions, feel free to fire them out. If you don't want them answered in a public forum, my contact information is right there. If you're just listening to the presentation, 727-754-9954 is my direct line, or a Perny, so APERNY at AdvantaIRA.com. Alrighty, ladies and gentlemen, I don't see any other questions coming in, so we'll go ahead and wind it down. If anyone has any questions, again, you can always reach out to me directly, grab a copy of the slides off the handout, and again, thank you very much for being with us today. I enjoy teaching these things. I hope you enjoyed listening to them, and with that said, have a great rest of your day.